Hey everybody! So today I wanted to hop on here and kind of talk about the current state of the real estate market right now, some big factors that are going on, and kind of where I think the market is going in the future, and whether or not I think we are heading for a real estate market crash or not. And spoiler alert, there is a possibility that it could go that way. I think it's a very small possibility, but I'll kind of talk about that a little later on. And I just want to hop on here and kind of answer some of your questions that you guys leave on my videos. If you guys have any questions, feel free to drop them in the chat as well. So before I kind of jump in, I want to start off by looking at a few charts. I'm looking at some data and just kind of going over where we're at in the real estate market right now. It's definitely been a crazy 2 years. Since March 2020, the real estate market has just been out of control and it's just been a wild ride. And all you can really do is just kind of hold on. But let's go ahead and take a look at kind of where we're at with the market right now. So if we go back to March, or let's go back to the beginning of 2020, right? This is really where things started heating up. And you see that around the time of the pandemic, the average home price was $283,000 in America. Today, 2 years later, the average home price is $391,000. So in just 2 years, the average home price has gone up $100,000. Now, if you're a homeowner, you're thinking like, great, I'm building up a lot of equity. But if you're a first-time home buyer, you're thinking, crap, I need to come up with an extra $100,000 now just to buy a home, just to get into a house. And I think that this definitely can have some big macro impacts on the millennials and kind of that generation, the first-time home buyer generation. Whereas the older generation, the baby boomers who have a house, maybe multiple homes, they're really kind of benefiting from this. So it's going to be really interesting to see how these couple of years really impact the different generations, potentially the rest of our lives. This could have ramifications going on for decades to come. But that's where we're at right now. As of right now, in the last 2 years, the average home price has gone up by about $100,000. I'm going to talk a little bit about why that is in a moment. Another really interesting chart is this one here, which is the total home sales. So you can see that we were hovering around 500 million home sales a year. Total existing home sales annual rate. Yeah, 5 million home sales a year in America. We hit the pandemic that quickly dropped off for a few months there. And then it came roaring back and we hit a peak of around, 6.5 million home sales. And really since then, it's been more or less declining, especially these last few months. The number of actual transactions has gone down further and further and further. And this is what's got me concerned. I think that this trend is going to continue. So why have the home sales gone down? It's just a lack of inventory right now. There's just not enough homes on the market for the buyers to actually buy. And because it's such a crazy buyer's market right now, like here in Maryland, the average home may be getting 5-6 offers per home within the first few days of hitting the market. 2 years ago, that was not the case. 2 years ago, it would take you about a month just to get one offer on a house. Now you're getting 5-6 within the first couple of days. I know people in like San Diego, they're saying they get 25 to 30 offers on every single property just because there's just not enough inventory. And so it's a catch-22 because what's going on now is that I have sellers that they want to sell, they want to move, but they don't want to be buyers in this market. And they're afraid if they sell their house, well, now they have to be a buyer in the market and kind of compete and everything with that. And so because it's such a crazy buyer's market, it's preventing more sellers from actually selling, which is further reducing the inventory in the market. It's a real like delicate balancing act right there. And I think so that's a big factor in it right now. And I think so the big question is that trend going to continue? Are we going to start seeing an uptick in home sales, or is this trend of fewer and fewer home sales going to continue downwards? I think it's going to continue downwards. And the reason for that is the rising interest rates. A lot of people, well, let's take a look at the interest rates real quick. So where did I have that? So here's the interest rates going back to about 2015. And you can see that They were up. So I remember a couple years ago, the Fed was trying to slowly raise interest rates up. They dropped them way down during the 2008 recession, and they kind of kept them pretty low for a long time. They started raising them back up. I remember Trump was really angry about that. The Fed started raising it. They got it back up to 4 or 5%. Then, March 2020 hit, and they had to drop them way down in order to try to stimulate the economy. Now, what's interesting is they dropped the interest rates to stimulate the economy, to create jobs and have growth in businesses and the GDP. They didn't necessarily want to lower mortgage rates, right? But it's just how it works. It's all tied together. It would have been great if they could have somehow lowered the rates to lend money to businesses, but kept interest rates where they're at. But I guess they couldn't do that, so they lowered interest rates by more than half. So from almost 5% all the way down to about 2.5%. And so we have a lot of sellers that have refinanced at a lot of these lower rates. I refinanced. I did a VA loan on my own home. I got 2.25% on a VA refinance, which is ridiculous and crazy. So now we're faced with a situation that if a seller wanted to move right now, they may have to give up that 2.5% interest rate or a 5% interest rate. That alone is going to be a deterrent to keeping sellers from selling their homes. That's a very real thing, that they don't want to refinance at a higher rate, so they just don't move. And I think that is going to cause this trend to continue of having fewer and fewer home sales. Now, right now, the number of home sales is really right around where it was just a couple of years ago. But I think that it may continue. It's probably going to drop below that. And the interest rates are what really have me concerned, because there are buyers that I've been working with that, we were looking at homes just a year ago, and they're getting a 2.5-3% interest rate. Now they're looking at, a 5%, 5.5, sometimes 6% interest rate. That has a huge impact on their purchasing power. So let me pull up a calculator here. And let's say you wanted to buy a $400,000 house at 5% interest rate. Your monthly payment with property taxes, insurance, all this stuff, estimate for that would be about $2,500, let's say $2,500 at a 5% interest rate. If they would have bought just a year ago, so $2,500 a year ago at 2.5% interest rate, they could have gotten a mortgage payment of $1,900 a month. So for no real particular reason, they're now spending an extra $600 a month. They're not getting anything back for that. They're not getting a bigger house or anything, just how the interest rates work. They're paying an extra $600 a month today than they would have 12 months ago. That sucks. There's no way to sugarcoat that. That sucks. I feel terrible for a lot of my buyers that are in that situation, because I have a lot of buyers that they wanted to buy. We were submitting offers, strong offers. I had one client, we were submitting $100,000 above list price on multiple properties. We still couldn't get it. That's in one very particular, like, kind of high-end neighborhood where it's no inventory. But it's so frustrating. And so now if they wanted to buy now, they would have to pay hundreds of dollars more a month just to get into that same house. But a better way to look at this is, let's say somebody had a fixed budget of $2,000 a month. So at 2.5% interest rate, let's see how much could they afford at a 2.5% interest rate and keep their mortgage below $2,000. Let's just throw in some numbers here. Yeah, so right around there. So 2.5% interest rate, you could afford about a $430,000 house. And this is how a lot of people look at it. It's how I look at my own finances, is what monthly payment do I want? And then figure that out first, and that'll determine how much I can afford. So let's say now that they have a 5% interest rate, how much can they afford? It's still around $2,000 a month. So right now they can afford $430,000 at 2.5, 5% interest rate. What can they afford? I don't know. Let's try type in like 375. Let's see. Nope, they can't even afford a 375. How about like 325? Can they afford a 325? Yeah. So it went from, what was it, like 420,000, down to $325,000. So because in the last 12 months, if you want to keep your mortgage rate at $2,000 a month, you can afford $100,000 less today than you could have 12 months ago because of these higher interest rates. So let that sink in and think about the ramifications on the market because of that. That you can afford $100,000 less today than you could have 12 months ago. And it sucks because I have buyers who are now like, well, we were looking in the 500s, now we got to look in the 400s, and they can't, one of the negative ramifications of these ridiculously low interest rates is that when the rates dropped, buyers are just throwing money at these houses and they're offering $20,000, $30,000, $100,000 above list price because the interests were so cheap. It's cheap money. But now that it's not cheap money anymore, they can't make these outrageous offers. So I do think that this is going to have a big impact on the homes. I think that homes are going to start getting less offers on them, and they're going to stop. Almost everything selling above list price for the last 2 years. I think that trend is going to stop. I think that it is going to level off. And when I mentioned before about a potential market crash, I think like if we keep it right here, right around 5% interest rate, I don't think there's going to be a market crash. I think the market is going to kind of level off, and homes will start appreciating at a much slower pace. But we're heading for potentially a recession here, and interest rates, a recession and hyperinflation. Inflation is a big factor in all this as well. And they may just throw the kitchen sink at it and raise interest rates to crazy levels to try to combat that inflation. The inflation they have zero control over inflation right now. You remember at the beginning of all this, they're saying that they wanted to keep inflation around 2%. Where's inflation? Now it's up at 8.25%, 8.5% CPI. So if that continues upwards or they can't get it down, they may increase interest rates even higher to try to combat that. So let's say the rates are at 5, let's say they go up to 7, 8% interest rate in order to combat that inflation. That is when you could get into home values dropping, right? Because let's say it goes up to 7%, that person who last year could afford a $420,000 house now can only afford a $325,000 house. If interest rates go up to 7-8% next year, they can only afford a $250,000 house, right? And there's just not going to be enough people who can afford these higher prices, and prices could drop. That's a very real possibility. I'm hoping it doesn't happen. I think that they're smarter than that. But if we go back, let's see how far back can we go. Back to the 1980s, interest rates were up in the 18%. Let that sink in. That's how high we could go. If mortgage interest rates were at 18%, you couldn't afford anything, right? Really, and back in the day when they were this high, people had to make bigger down payments. That's what they really had to do. Today, most people put as little down as they can. And it kind of makes sense with really low interest rates to do that. But when you're at 18%, it means that you're going to really save up a nest egg and put a bigger down payment, which means that people are going to be purchasing homes later on in their lives. They're going to be renting more for longer. And again, that could have huge ramifications on the generations. And the kind of these millennials may kind of get screwed over in that because they may not be able to afford a home until their 30s or maybe even their 40s. This is going to have this 2-year period is going to have ramifications that last for generations, which is super, super frustrating. So we really got to pay attention to this, to the interest rates, and God, just look how quickly they raised those rates, man. They didn't ease into that at all. They just dramatically within a year doubled the interest rates. They could do it again. They could go up to 10%. Now, I want to talk about inflation a little bit. So inflation really is turning into a pretty big issue here. Now, like when I say that home values have gone up $100,000 in the last 2 years, you need to factor in that a part of that is inflation. So they've gone up $100,000. So the value of the home has gone up relative to the US dollar, but the US dollar is losing its value That is why. That's why you need more US dollars to buy a house today, because the US dollar is also losing its value. And you can see on this chart here that inflation is usually around 2 to 3%. The last 10 years is always around 2 to 3%, pretty manageable. Now it's up to 8.5%. Now we did have a little bit of a pullback from 8.5 to 8.2. A lot of people are pretty excited about that, but I don't. That may be nothing. That may be a small blip. These inflation numbers may keep going higher. And so where are these really coming from? Politicians will tell you it's because of Russia and supply lines and stuff. The real reason is that we printed trillions and trillions and trillions of dollars out of thin air during this pandemic and gave it to everybody. You remember all the stimulus checks that we got? Where did that money come from? Did we raise taxes to raise that money? Did we borrow that money? Did we increase, the domestic output or something like that to raise that money? No, we printed that money out of thin air. And this is both Trump and Biden. Under Trump, they increased the total amount of US dollars by 20%, right? They were just printing money out of thin air. Biden took over. He continued that policy, right, of just printing money. And I shouldn't say it's Biden or Trump. It's actually the Federal Reserve. And the Federal Reserve is supposed to be completely neutral from any politicians. So the politicians can't actually tell them what to do. They can infer, they can imply, they can suggest, but they don't actually have authority over what the Federal Reserve does. So it's not really either of those politicians. It's really the Fed. So Jerome Powell is the chairman of the Federal Reserve, and he's been kind of in charge of all this. But we've dramatically printed trillions of dollars out of thin air. And so now the inflation is catching up to us, where the US dollar is losing its value. But when you see like 8.5% inflation rate, you need to really figure out how much homes have appreciated. You need to deduct that inflation. So if somebody says, homes have appreciated 15% in my area in the last 12 months, great, but take away minus 8.5% for inflation to really figure out how much homes have really appreciated. And even this number, 8.5%, it's most likely BS. This is most likely an underestimation. This is from the CPI, Consumer Price Index, and just a complicated math formula. And a lot of people criticize how they formulate that. Off the top of my head, one of the things that they track in there is people's housing expenses, how much they pay on mortgage and rent. And I think they only account for like 20% of the entire formula is housing. But the average American spends almost 50% of their paycheck on their housing. So that housing should be more like 50% of that total formula, not like 20, 25%, whatever it was. Figure out for yourself, your monthly income, how much of that is going towards your rent or your mortgage? It's probably close to 40, 50%. And so they greatly underestimate housing expenses with this CPI formula. And a lot of people are saying that the actual inflation rate is in the tens, right? Maybe 12%, maybe 15% right now. So this number is kind of incredibly conservative and I think a little misleading. But if inflation keeps going up, I think that it shows how in real estate is a great hedge against inflation. As inflation goes up, the value of homes go up as well. Real estate is a great hedge against inflation to protect your money. Now, if you had, let's say, $100,000 in your bank account for the last 12 months, you just lost $8,500 of it because of 8.5% inflation. Let that sink in. There are certain wealthy people know how to take advantage of inflation. You take advantage of inflation by owning assets that appreciate with inflation. Stocks appreciate with inflation. Real estate appreciates inflation. Gold generally does. And they keep their money out of cash because cash loses value with inflation. And so to kind of play this game, you need to kind of play at their levels and don't hold on to cash. Cash is trash. As soon as you get cash, invest it in some sort of asset that appreciates with inflation, like real estate. So I think that's enough rambling for a little while there. We got a good morning, Malcolm, from Lakeland, Florida. Kevin, man, thanks for joining me today. So let's take a look. I have a couple of questions that I wanted to pull up from my YouTube channel. And let's take a look at a few of these questions from some of my videos. So this is a video I have about paying your mortgage off early. So it says here, what if the mortgage company doesn't accept bi-weekly payments? It's ridiculous. I don't think they should be able to tell you that you can or cannot do that. Yeah, so some mortgage payments companies don't allow bi-weekly payments. It's really frustrating. What they tell you is, oh, well, we'll take your payment bi-weekly if you want. We'll hold on to it and then apply it towards your payment at the end of the month. I hate how they do that. And so let's say, but some companies do allow you to do that. So what he's talking about here is, there's saying that if you pay your mortgage off bi-weekly instead of monthly, that you'll pay your mortgage off years earlier, like 5, 6 years earlier. You'll save, potentially tens of thousands of dollars. And what it really comes down to, if you pay bi-weekly, you effectively are getting one full mortgage payment extra every single year. So every year you're paying an extra mortgage payment into that. So if your company doesn't allow you to do that, but they allow you to pay down the principal early or make extra payments toward the principal, which most companies will, what you got to do is figure out, okay, well, what's my mortgage payment? Let's say $2,000 a month. Divide that by 12 months. You get, I don't know, $180. Just pay an extra $180 a month on your principal. And that is the equivalent to one extra mortgage payment a year, or equivalent to you paying bi-weekly. So just keep that in mind, that you can just kind of add more money to your principal every single payment that you make, rather than doing this bi-weekly payment thing. We got so Tia Poi says, hello, sir. Do you have to refinance as a rental property? So he's talking about on one of my videos about how I use the VA loan to buy my investment property. And the trick is you have to buy it as your primary residence first, but then you can move out and you can use the VA loan a second time if you have enough money left over. Which is exactly what I did. And no, you do not have to refinance it. I currently have 2 VA loans out right now. And the trick is that combined, so you have a maximum cap of how much of a VA loan you can take out if you have multiple properties. And combined, those two values are less than that maximum cap, which is how I can use a VA loan to own 2 different properties at the same time. There's some nuances to that, but that's generally it. You don't have to refinance, but you could if you really wanted to, especially with interest rates. What about refinancing for the amount of years you have left with less interest rates? Example, I paid 5 years of my 30-year mortgage and refinanced at 1% or more, less than previous rate. Okay, for 20 years. Would that still be a scam? So the tricky thing with refinancing is that the average person lives in a home for about 7 years. And so if you are going to stay in that home for 30 years, it could make sense to refinance. It could. But if there's any chance that you think you may be moving 5 years, 10 years, 15 years, it may not make sense. And what you really need to do is what's known as a break-even analysis. In a break-even analysis, you're going to figure out, so to refinance, it costs money generally. It may be $5,000, maybe $10,000. They usually add it to your principal. So you got to say, okay, so I'm spending $5,000 refinance, and I'm going to save $100 a month over the next, so many years. How long until I earn that $5,000 back? That'll be your break-even analysis, a break-even point. And if you intend on living the home past that point, then it could be worth it. Now, another thing though is another thing you need to factor in though is that there is a amortization chart. So when you're at the beginning of a 30-year mortgage, less of your payment is going towards principal, more of it is going towards just interest rate. As you progress in that 30 years, kind of towards the end, more of your monthly payment is going towards that principal, building you equity, and less of it's going towards interest rate. And so when you're refinanced like that, you're resetting that for another 30 years. You're going back to those early years where you're building almost no equity. You're not really paying down your mortgage your principal at all. Very little going towards your principal. And so if you're 5 years into a 30-year amortization, just keep that in mind, man. You're going to be resetting, going all the way back to the beginning, and you're not going to build as much equity over the next 5 years as you would had if you stayed with that current one. And so that's another thing you need to factor in. Do the break even analysis, look at your monthly payment, how much you're going to save, but also figure out where you're at in your amortization schedule. And, how much equity would you build over the next 5 years if you continued from, the fifth year to the 10th year versus starting all over and starting from year 1 to year 5 again. It gets complicated. I know they really complicate things, I think, on purpose. It's kind of frustrating. But I will say, like, yeah, I mean, I refinanced recently, because interest rates were almost half of what they were, and I got 2.25% on this home right here, which is crazy low. I don't know if I'm ever going to see interest rates like that again in my entire life. And I do intend to hold on to this property, and I may not live here forever, but I probably will hold on to this property as an investment property. So that's another thing. If you are going to hold on to the property, hold it as an investment property, it could also be worth it as well. All right, so we got, why would you pay off early when you can just invest the difference and grow your investment well above 7% versus 3.5% mortgage? Yeah, great question. Great question. So paying off your mortgage early is not the goal for everybody. That's not the goal for me. And it really comes down to what interest rate you're paying on that mortgage. So if I have 2.5% interest rate, right? And I have an extra $10,000. I could put that $10,000 towards paying off my principal of my mortgage to avoid paying 2.5% interest on that $10,000, or I could invest that $10,000. Now, if I invest that $10,000 and it earns more than what my mortgage is, let's say 2.5%, it's smarter in the long run for me to invest that money. And with the stock markets been on a roar lately, well, let's say you can get, on average, is typically about 9% return on the S&P 500. So let's say you're faced with, I can stick this in the S&P 500, get a 9% return on my $10,000, or I can avoid paying 2.5% on that. Yeah, it's probably much smarter for the average person to invest that money than it is to pay off your mortgage early. But with interest rates rising now, that's going to change. So now you're faced with a 5% interest rate. So in order for it to make sense for you to invest that money, it has to appreciate in value more than 5%. It has to outperform the mortgage. I mean, let's say you invest it and you only get a 4% return. It would have been smarter just to avoid that 5% interest rate rather than get a 4% return on that. So this is kind of general, and this is really if you have a longer time frame. Now, like I'm 37 now, right? I'm still investing. For me, I think it makes more sense for me to invest my money and pay off my mortgage early, especially with the low interest rates that I have. But like my parents, they want to retire soon, right? They, if they could pay off their mortgage and have no mortgage payment whatsoever, that could enable them to retire, And so for them, they are trying to pay their mortgage off. As soon as they pay that mortgage off, they can retire, right? Without that having that $2,000 monthly expense. So for them, it just makes more sense just to go all in, and really try to get that down as quickly as they can. And other people have different goals. Some people want financial freedom, or they just don't want to be, burdened by that. If you want to retire early, for example, I do kind of want to retire early as well. Maybe one day I'll pay off my mortgage completely, just so I can not have that expense and actually, retire early or so. So it kind of depends on your specific situation. But as interest rates go up, if interest rates go up to 7-8%, it may make more sense to pay down your mortgage early than to invest your money in the long run. Do you have to live in the property for 1 year before you can rent it? And what if I travel out of the country every month? Will that be allowed under VA rules? Yeah, you can. You just have to claim it as your primary residence. So if you were traveling every single month, that's perfectly fine. So we're talking about buying a home with a VA loan. And yeah, when you when you purchase a home, you're going to sign a paper saying that you intend to live in this home for at least 1 year. Now, I've seen people buy a home with a VA loan and then their orders change, like active duty military, and they never actually even see the house. They just instantly turn it into a rental property because their orders changed. I've seen that, or I've seen people get divorced and stuff, and there's tons and tons and tons and tons of exceptions to that. But I think like how the verbiage is that you intend to live in it. They really want the VA loan to be used as your primary residence. I've never heard of anybody actually tracking people or enforcing that somehow, or somehow becoming aware of that. But that's the intention is you're supposed to live in it for at least a year. Now, if you lived in it for 6 months and then you rented it out, I have no idea how the VA would even know that or what they would do about it. I don't think they would do anything. But don't quote me on that. I don't really know. Hold on, let's see. So we got a comment. I got to get back to work now, but would love to see more of your videos. Keep up the good work. Yes, thank you. I do want to try doing more live streams like this. I like this kind of format. A little bit more, less work than, one of my traditional videos. I like just kind of chatting, talking to people, answering questions like this. So I'm hoping to get back into this. So where was I at? I did this one. So super helpful. Thank you. Is it better to have an empty home or to have it furniture? Furniture is a little outdated. Yeah. So this is kind of a controversial question here, or at least I have a controversial answer. I think it's better for the home to be completely vacant and empty. There's other real estate agents that will tell you like, oh no, you want to have some furniture, leave your furniture in there so they can envision what the house is supposed to look like and what the rooms are for. I don't think so. I think it's just better to have it completely empty. The truth is, like when I walk around with buyers, some of them feel pretty awkward going through somebody's house like that. When there's a lot of furniture, there's photos and everything, you can tell somebody's living in there, and it is a little awkward going to somebody's house like that. I think if it's completely vacant, one, it makes the house look bigger. There's a lot of stuff in a room, it makes it look and feel smaller. So if it's completely vacant, I think it makes it look bigger, makes it look cleaner, kind of a clean blank slate. When you if you're moving out couches and everything, like you have to kind of worry about like, oh, are there stains or tears or anything underneath those couches after they move out? So I personally like just completely emptying out a house. I think it looks and feels better, a little bit more cleaner for potential buyers. Now I do sometimes do digital staging. So I'll get the house completely vacant. I'll take empty photos of it, and then I'll use pay somebody to use a computer program to put some furniture in there, and that kind of make the pictures look a lot nicer, I think. It's very rare for me to actually pay for staging unless it's like a very high end house. And sometimes you do pay for staging. It could be worth it. But generally, I like houses to be empty. Personally, I think pictures look a lot better too. What if you do not plan on being in the same house for a full 30 years? Is it a waste of money to try to pay it off if you already know you won't? Kind of. Yeah. If you're not going to be in the house for 30 years, well, if you're not going to be in the house for 30 years, you really want to factor that in when you're refinancing. Like maybe it's not worth it to refinance. Same thing with buying points on your mortgage. I hate this. I hate when I see lenders talking clients into buying points on their mortgage. And points are essentially you're paying interest rate up front to get a lower interest rate. And I hate it because like I'll see clients like, oh yeah, my guy talked me into spending an extra $5,000, but I get like in a full point of interest rate lower. I'm like, okay. But like you're only going to break even on that after like 9 years of living in the house, right? And they're like, no, what do you mean? Well, okay, well, let's say it's $5,000. I'm going to make up some numbers, or you maybe actually do the numbers. But let's say it's $5,000 to buy a point on your mortgage, which is going to lower your interest rate. And let's say it lowers your interest rate by like $150 a month. Well, great. So how many of those $150 a month savings do you need before you make up the $5,000 investment that you made to get that lower interest rate? It's going to be a couple of years. And I've seen clients that do that, and then they move out of the house like 4 years later. And I was like, oh, what are you doing, man? Like you're just throwing money away by buying these points and not actually, living in there for a long time. It's very similar to refinancing. Sorry, what was your question? I got lost there. Yeah, if you're, what if you don't plan on being in the same house for 30 years? Is it a waste of money to pay it off? Yeah, I mean, it's not necessarily a waste of money. It's it's also sort of like a savings account that you can't touch. You can look at it that way. And let's say, yeah, yeah, it's like a savings account that you can't touch. If you're putting in $100 extra a month into your mortgage, it's kind of out of sight, out of mind, and you can't touch it until you sell your house. So some people like looking at it that way. But if you're young enough, you got a long enough timeline, I would say that there's just better places you can stick your money to get a better return than paying down your mortgage early. So if again, if you're at like a 3% interest rate, if you can, so you're paying, you put an extra $100 a month towards that, you're essentially saving 3% on $100 a month. That's really what you're doing on the total time span of the mortgage. But you could also invest that in a lot of things and get a better return on than 3%. Real estate, gold, precious metals, oil, stocks, cryptocurrencies. Most of these things will probably give you a better return than paying off your mortgage early. So I don't always recommend paying off your mortgage early, except for some unique situations, like if you're trying to retire, something like that. So in general, is it better to put more money towards the principal of your mortgage payment or put the additional money towards investing instead? Yes, thank you. That's exactly what I'm talking about here. In general, it's better, I think, if you're a young enough person, I think it's better to invest that money. Gonna get compound interest on it as well. You can earn. So like there are companies that pay dividends that are like 2-3%. So you could get a dividend on a stock that is more than the what your mortgage payment is, right? So let's say you have a 3% mortgage payment, you can invest in a stock and they'll pay you 3% of that money every single year in the form of a dividend. And most likely that money is going to go up. All right, so I want to talk another thing I kind of forgot about with inflation. So one of the best ways to take advantage of inflation is to have a lot of debt. This is incredibly controversial, but I think that the math works out for this. So let's say you take out a loan for $400,000. With inflation, every time inflation goes up, that the value of that debt is effectively reduced. So your debt doesn't go up with inflation. Your debt stays the same, but the value of $400,000 goes down a little bit more and more and more. Think about it. It works out, this is why, in 1970, you could buy a house for $80,000. Just think about if you bought a house 30 years ago with you only pay the interest rate, right? You don't pay anything on the principal. You only pay the interest rate. You still have that same payment now. That house that you would have paid, $100,000 for is now worth $400,000. A big part of that is inflation. So keep that in mind that having debt can be very beneficial. And this is part of the game that the wealthy people play is that they'll take out, $100 million loan and then we get 8% inflation. And that loan is effectively that the value of that $100 million is effectively reduced by the inflation amount of 8% or so. So if you think that inflation is going to continue to rise, which I do, having a lot of debt like that in the form of a mortgage can be very beneficial because your debt's getting reduced with inflation. So like I have a $360,000 loan on this house. We have 8% inflation right now. That $360,000 effectively reduced by 8% because of that inflation. You see, so there's actually benefits to having a lot of mortgage debt. Now, don't twist this and think that I'm talking about like car payments or student loan payments or credit cards. That's all bad debt. I don't like any of that debt. That's 10% interest rate, 25% interest rate, whatever it is. But if you're talking about 2-3% interest rate, 4-5% interest rate, it can actually be beneficial in the long term to have that debt because your debt is reduced with inflation, right? That's a really controversial thing that nobody really talks about, but it's the truth. So it's kind of an interesting concept to think about. So just kind of keep that in mind. Like if you own a home right now, you may be feeling a little bummed about interest rates and everything, but just keep in mind that like you're benefiting from this inflation. All right, guys, I really appreciate everybody tuning in today. This was fun. I want to do more of these live Q&As like this. I want to get more active on this channel. I know I haven't uploaded in almost a year, probably over a year on this channel. There's had a lot of life stuff going on. But yeah, I think I definitely want to get back into the groove of things. Definitely an interesting, kind of an exciting time in the real estate market. And there is a possibility for a crash, but I think it's very unlikely. I think that the Fed, we really got to keep an eye on what the Fed is doing with those interest rates. If they raise them too quickly, it could have real negative impact on the housing market. But as long as they keep them where they're at, or they only slowly, steadily increase them, I think it could have, not be that devastating to the market. So, all right, I'll see you guys on the next one.